In the year 2000, Enron was worth about $70 billion. For 6 years running, Fortune magazine had named it the most innovative company in America. Its stock traded near $90 a share, its executives were celebrated as geniuses, and Wall Street analysts who dared to question it were mocked. Then, in a matter of weeks, all of it vanished. The profits were not real. The growth was an illusion. Billions of dollars in debt had been hidden inside secret companies with names like Raptor and Chuco. 20,000 employees lost their jobs, and many lost their entire retirement savings, while the men at the top had quietly sold their own shares. This is the story of how the most admired company in America turned out to be one of the largest frauds in history.
Take a seat! This meeting has one item on the agenda. How Enron, a company once worth $70 billion and praised as the smartest business in America, collapsed into bankruptcy in under 3 months and took the savings of thousands of ordinary people down with it. Most of the stories told at this table are about products that failed or markets that turned. This one is different. Enron did not fail because its idea was bad. It failed because somewhere along the way, it stopped reporting what was true and started reporting what it wished were true. The minutes run 9 minutes. Stay for the lesson at the end. It is the most expensive lesson in modern accounting.
Enron was born in 1985 when two pipeline companies, Houston Natural Gas and InterNorth, merged. At its head was Kenneth Lay, an economist with a doctorate and a gift for politics. In its early years, Enron was an ordinary business. It owned pipelines and sold natural gas. There was nothing exciting about it. Then, a former consultant named Jeffrey Skilling arrived with an idea that would transform the company and eventually destroy it. Skilling did not want Enron to simply own pipelines. He wanted it to trade energy the way Wall Street traded stocks. Enron would become a kind of bank for natural gas and electricity, buying and selling contracts, betting on prices, and taking a cut in the middle. To make this vision work, Skilling demanded a new way of keeping the books, called mark-to-market accounting. In plain terms, it meant this. The moment Enron signed a long-term deal, it was allowed to record all of the profit it expected to earn over the entire life of that deal, immediately, as if the cash were already in the bank. A contract that might pay out slowly over 20 years could be booked as one enormous profit today. On paper, Enron looked like it was growing at a breathtaking pace. The stock climbed, the praise poured in. Fortune magazine named it the most innovative company in America, 6 years in a row. There was a problem hidden inside this magic. Mark-to-market profits were not money, they were predictions. And when those predictions turned out to be too optimistic, when a deal earned far less than Enron had already claimed, the company faced a terrible choice. It could admit the truth and report a loss, shocking the market it had spent years dazzling. Or it could hide the gap. Enron chose to hide it, and the man who built the machinery of hiding was its chief financial officer, Andrew Fastow. Fastow created a web of secret partnerships and shell companies, structures with cryptic names like LJM, Chuco, and the Raptors. On paper, these were independent businesses. In reality, many were controlled by Enron itself, and in some cases, by Fastow personally. Their purpose was simple and devastating. Enron used them to move billions of dollars in debt and failing investments off of its own balance sheet so that the public, the regulators, and the analysts would never see them. To the outside world, Enron looked clean, profitable, and unstoppable. Underneath, it was hollow, propped up by a stock price that the hidden companies themselves were secretly designed to support. The entire structure depended on one thing: Enron's stock had to keep going up. If it ever fell far enough, the whole illusion would unravel at once.
I want you to understand what was actually happening here, because the names are designed to confuse you. Strip away the jargon, and it is very simple. Enron borrowed enormous amounts of money, and then hid the borrowing inside companies it secretly controlled, so that its own accounts would look healthy. It recorded profits it had not yet earned, and might never earn, as if they were already real. And it did all of this while its auditor, the accounting firm Arthur Andersen, signed off year after year. There is a lesson at this table that has been paid for many times, always in full. When a business becomes more devoted to protecting its story than to telling the truth, the story does not save it. The story is what kills it. Enron did not lie because it was failing. It began to fail because it had to keep lying.
For years, almost no one questioned it. Wall Street banks earned enormous fees from Enron's deals, so the incentive was to cheer, not to doubt. Then, in March of 2001, a journalist named Bethany McLean wrote an article in Fortune with a simple, dangerous question for a title: Is Enron overpriced? She had tried to understand how, exactly, the company actually made its money, and found that almost no one could explain it. The reaction from Enron was fury. Executives tried to discredit her. On one now famous conference call, when an investor pressed for real financial detail, Jeffrey Skilling insulted him on the line in front of everyone listening. It was the behavior of a man who did not want to answer the question. Then the cracks became impossible to hide. In August of 2001, Jeffrey Skilling, the architect of the whole machine, abruptly resigned as chief executive after only 6 months in the job, citing personal reasons. That same month, an Enron executive named Sharon Watkins wrote a memo to Kenneth Lay, warning him that the company might implode in a wave of accounting scandals. She turned out to be exactly right. On October 16, 2001, Enron reported a loss of more than $600 million in a single quarter and revealed that it was wiping out more than $1 billion of shareholder value tied to those secret partnerships. The Securities and Exchange Commission opened an investigation. Andrew Fastow was forced out, and once auditors finally began pulling at the threads, the company had to restate years of past earnings, admitting that profits it had reported were never real. The credit agencies downgraded Enron's debt to junk. A rescue merger with a rival, Dynegy, fell apart when the true scale of the rot became clear. The stock, which had traded near $90, collapsed toward zero. On December 2, 2001, Enron filed for bankruptcy, the largest in American history at the time, with more than $60 billion in assets. Roughly 20,000 employees lost their jobs. Worse, many had their retirement savings tied up in Enron stock, and during the final collapse their accounts were frozen, unable to sell, while they watched their life savings evaporate. The men at the top had sold tens of millions of dollars of their own shares on the way down. Enron's auditor, Arthur Andersen, one of the largest accounting firms in the world, was caught shredding documents and was convicted of obstruction of justice, a verdict that destroyed the 89-year-old firm. Kenneth Lay and Jeffrey Skilling were both convicted of fraud in 2006. Lay died weeks before his sentencing. Skilling went to prison, and, in the wreckage, Congress passed a sweeping new law, Sarbanes Oxley, to force honesty into corporate accounting, a law that every public company in America still lives under today.
Minutes recorded. Before we adjourn, one question for the room, and do leave your answer in the comments. For 6 straight years, the smartest analysts, the biggest banks, and the most respected business magazine in the country all looked at Enron and saw a genius. Almost none of them looked closely enough to see a fraud. So tell me, when everyone around you is certain that something is brilliant and no one can quite explain how it actually works, do you trust the crowd? Or do you ask the one question Enron could not survive? How, exactly, do you make your money? Next meeting. A man who got fired from a company he helped build sold running shoes out of the trunk of his car and turned a handshake deal into the most famous brand in sport, Nike. Subscribe. Attendance is taken. Minutes recorded. Meeting adjourned.